A Random Walk Down Wall Street G by Burton Gordon Malkiel, published in 1973. A Random Walk Down Wall Street G by Burton G. Malkiel is a seminal work in the field of investment and finance. The book popularized the idea of the random walk hypothesis, which suggests that stock prices evolve according to a random walk and thus cannot be predicted. Malkiel's work serves as both a comprehensive introduction to investing and a critique of various investment strategies, advocating for the efficiency of markets and the benefits of passive investment strategies. Main concepts *. 1. Random walk theory *. Malkiel explains that stock prices move in a random and unpredictable manner. This randomness implies that past stock prices cannot be used to predict future prices, and therefore, traditional stock-picking methods and technical analysis are ineffective over the long term. 2. Efficient market hypothesis, EMH. The book argues in favor of the EMH, which posits that at any given time, stock prices fully reflect all available information. Consequently, it is impossible to consistently achieve higher returns than the overall market through expert stock selection or market timing. 3. Investment strategies *. Malkiel critiques several popular investment strategies, including technical analysis, using charts and patterns to predict stock movements, and fundamental analysis, analyzing a company's financial statements to determine its value. He demonstrates that neither approach consistently outperforms the market. 4. Modern portfolio theory, MPT. The book delves into MPT, which emphasizes the benefits of diversification. By holding a variety of uncorrelated assets, investors can reduce risk without sacrificing potential returns. This theory underpins the rationale for index funds, which Malkiel champions. 5. Behavioral finance *. Although primarily a proponent of the EMH, Malkiel acknowledges that psychological factors can sometimes influence investor behavior and lead to market inefficiencies. He discusses concepts such as overconfidence, herd behavior, and loss aversion, which can cause irrational decision-making. 6. Index investing *. One of the book's core recommendations is to invest in low-cost index funds. These funds passively track a market index, such as the S&P 500, and provide broad market exposure. Malkiel argues that this approach is superior to actively managed funds, which often fail to outperform the market after accounting for fees and expenses. 7. Long-term investing *. Malkiel emphasizes the importance of a long-term perspective. He advises investors to stay the course during market fluctuations, avoid trying to time the market, and benefit from the power of compounding over time. Detailed summary *. Chapter 1. Firm foundations and castles in the air. Malkiel begins by contrasting two competing theories of stock valuation, the firm foundation theory and the castle in the air theory. The firm foundation theory asserts that each investment has an intrinsic value based on factors like earnings, dividends, and growth rates. Investors can make money by buying undervalued stocks and selling them when their price corrects. The castle in the air theory, on the other hand, focuses on market psychology. It suggests that the value of stocks is determined by what investors believe others will pay for them in the future. Malkiel argues that while both theories have merit, neither can consistently predict stock prices due to the market's inherent randomness. Chapter 2. The Madness of Crowds. This chapter explores the history of speculative bubbles, such as the Dutch tulip mania, the South Sea bubble, and the more recent, as of 1973, stock market booms and busts. Malkiel illustrates how irrational behavior and herd mentality can drive prices far beyond their intrinsic value, only to result in dramatic crashes. Chapter 3. Stock valuation from the 60s through the 90s. Malkiel discusses the evolution of stock valuation methods, noting how different decades brought different valuation trends. He highlights how changes in interest rates, inflation, and investor sentiment impacted stock prices during these periods. Chapter 4. The Firm Foundation Theory of Stock Prices. In this chapter, Malkiel delves deeper into the firm foundation theory, explaining how fundamental analysis attempts to determine a stock's intrinsic value. He covers various valuation models, including dividend discount models and earnings multipliers, but cautions that these models are often based on assumptions that may not hold true in the real world. Chapter 5: The Weaknesses of Fundamental Analysis. Malkiel critiques fundamental analysis by pointing out its limitations. He explains that even the most thorough analysis cannot account for all the variables that affect stock prices, such as future economic conditions, political events, and technological advancements. Moreover, he shows that many professional analysts fail to consistently outperform the market. Chapter 6: Technical Analysis and the Random Walk Theory. Technical analysis, which involves studying past price movements and trading volumes to forecast future prices, is scrutinized in this chapter. Malkiel argues that if stock prices follow a random walk, then technical analysis is no better than flipping a coin. He presents evidence that past price movements do not provide reliable indicators of future performance. Chapter 7: The New Investment Technology. This chapter introduces modern portfolio theory, MPT, and the capital asset pricing model, CAPM. MPT suggests that investors can construct an optimal portfolio by diversifying across various assets to minimize risk. CAPM provides a framework for understanding the relationship between risk and expected return, highlighting the importance of a securities beta, which measures its sensitivity to market movements. Chapter 8: A New Walking Shoe, Modern Portfolio Theory. Malkiel further elaborates on MPT, explaining how diversification can reduce unsystematic risk specific to individual assets. He discusses the efficient frontier, which represents the set of optimal portfolios offering the highest expected return for a given level of risk. Chapter 9: Reaping Reward by Increasing Risk. The focus of this chapter is on the trade-off between risk and return. Malkiel explains that while higher-risk investments generally offer the potential for higher returns, they also come with greater volatility. He advises investors to consider their risk tolerance and investment horizon when building their portfolios. Chapter 10: Behavioral Finance. Malkiel acknowledges the limitations of the YMH by exploring behavioral finance, which studies how psychological factors affect investment decisions. He discusses various biases, such as overconfidence, anchoring, and the disposition effect, which can lead to suboptimal investment choices and market anomalies. Chapter 11: Potshots at the Efficient Market Theory and Why They Miss. Critics of the YMH argue that markets are not always rational and that inefficiencies can be exploited. Malkiel addresses these critiques by showing that while anomalies and inefficiencies exist, they are often fleeting and difficult to exploit consistently. He reinforces the idea that for most investors, a passive investment strategy remains the best approach. Chapter 12: A Practical Guide for Random Walkers and Other Investors. In the final chapter, Malkiel offers practical advice for individual investors. He emphasizes the importance of saving early and regularly, diversifying investments, and minimizing fees and taxes. He advocates for a mix of stocks, bonds, and real estate investment trusts, REITs, to achieve a balanced portfolio. Malkiel also highlights the benefits of dollar-cost averaging, which involves investing a fixed amount regularly to smooth out market volatility. Conclusion **. A Random Walk Down Wall Street is a cornerstone text for anyone interested in investing. Burton G. Malkiel's insights into the random nature of stock prices, the efficiency of markets, and the importance of diversification have profoundly influenced modern investment strategies. The book's advocacy for low-cost index funds and a long-term investment perspective remains highly relevant, offering timeless advice for building a robust and resilient investment portfolio. By blending theory with practical guidance, Malkiel empowers readers to navigate the complexities of the stock market with confidence and discipline, making it a must-read for both novice and experienced investors alike.